Good afternoon. My name is Kent Scornia, President and CEO of Krilogy, and I'm here with my partner, John MacArthur, Chief Investment Officer here at Krilogy, and this is your December market perspective. Johnny?
Kent?
Merry Christmas, belated.
Merry Christmas.
Here we are at the end of the year. It's been quite a ride, as always.
It has, last couple months especially.
Last couple months, really last couple years. 2022 was challenging in a lot of different ways. Market had a challenging year, but also the bond market really got hurt as the Fed dramatically raised interest rates. Prices of the market and the bond market fell quite dramatically and really put a damper on a lot of portfolios. But here we are at the end of 2023. Market's up quite a bit. Bond market has come back. Yields are still decently high, but actually we've got a little bit of capital appreciation back in the bond market. So what's your thoughts?
For the first time. Yeah, I think it's a great lesson of the importance of staying in the game.
Yeah.
You know, I think we talked about in prior monthly meetings being positioned for an inevitable decline in rates at some point or not, and it happened really fast. I mean, we declined, the 10-year Treasury declined 120 basis points in really short order.
And I recall in our August market perspective, if I recall right, either that or September, I feel like it was August.
Yeah.
You and your team were starting to make some adjustments. Paul Gabriel,
starting
our chief strategist in the bond market. Charles Flecky also made some adjustments there with Paul and
Jake Thornton.
Jake Thornton.
The team.
As the team, we're starting to say, hey, time to lengthen the duration, see if we can catch them upside here, and it worked.
Well, that's the key. It's all about process. There's lots of humility around being able to time those things, whether we're talking about equities or fixed income. But the process and the conviction around staying disciplined, when there's conviction around it paying off, just not knowing quite when is really important. And
you're not taking huge,
correct,
decisions here. I mean, you're
correct.
It's a big decision, but you're not allocating so much of the portfolio that creates excess risk.
Right. It's designed to move around a core allocation and make some tactical adjustments. Drive risk-adjusted returns, some alpha, and the portfolios have done that. So
rates peaked somewhere in October.
They
Since
did.
then, they've been falling.
Yeah, it's interesting. We saw, the 10-year peaked over 5%. Here we are at 3.8. And again, as we discussed in really short order, similar with equities, actually bottomed, not too ironically bottomed around October 27th when we peaked in rates.
Right.
There's been a strong negative correlation there, and we had that 3-month decline in equities, which we discussed as being really, really rare, 3 months negative in a row, and pessimism had swung. Now we're on the other side of that with a great deal of optimism at this point. But, the S&P has surged 16% in 40 days. We've just had some incredible statistical events happen. Small caps have rallied 16% in the last 25% in the last couple months. We talked about equal weight S&P, or we really talked about sectors other than tech.
Right.
And that catch up has really happened. The equal weight S&P has granted in a short period of time over the last 4 to 6 weeks has outperformed the tech sector in and of itself. Or the QQQs. So we're seeing a broadening out of the rally, which is really quite healthy, which takes us into, perhaps a period more like 2022, irrespective of really whether we continue to march higher from here or whether we march lower. We expect that broadening out based on valuations and hopeful earning strength, which the market is forecasting to start to show up elsewhere.
And I would also, to add to that, that was a big moment when small caps and really the Russell 1000, 2000 started to come along with the Magnificent Seven.
You're
absolutely right. The 7 tech stocks sitting out there that have really been leading the charge for multiple years now.
They have, yeah.
So that was a big moment. Sure. And now all of a sudden they sort of caught up. We're starting the broadening of these returns. Because there was a fear that if the tech rally fizzled quickly and the broadening of the rest of the market didn't hold on strong, we were going to have some problems.
Yeah, tech would have then rolled over. Yeah. So we're at an interesting point now. This is irrespective of how we got here at all-time highs again. It's celebration of the Fed acknowledging some completion to the rate hiking cycle. I would contend that they're winning the battle of inflation, but perhaps the war's not over.
Yeah, I would say that there's still trillions of dollars out there in the economy that needs to be spent or will be spent.
Yeah, it could be a longer process in that regard. So any pickup in yields, which would be normal given the magnitude of the decline, could create some adversity for equities as we march forward into Q1. But I think for perspective, Goldman Sachs has a financial conditions index. These last 2 months have been weaker than any time historically outside of March of 2009 and March of 2020.
Yeah.
So the tailwinds are there. Weaker dollar's down 7%. We talked about yields rolling over. So it's hard to suggest that momentum continues, at least near term. Again, humility around what happens over the days and weeks, months to come. Nobody has that visibility, but it would be normal to see some type of pause here, if not, some type of consolidation.
Right. So talk about different parts of the equity market. We mentioned tech, we mentioned the S&P, and the Russell small caps. We've yet to mention international. I know we spoke of, sort of longer term, really long term thinking. There's great opportunity in the international space. Obviously, geopolitical issues going on right now.
Yep.
You'd be really careful of what you're stepping into.
Yeah, you bet.
But what other parts of the market?
There's earnings growth happening global. Certain segments of the international landscape are, or have been in a recessionary type of environment, really leading the U.S., which we can talk about domestic recessionary probabilities here, but I mean, we talked about the dollar peaking probably mid last year. We had that conversation, and that being a tailwind for assets outside of the U.S., and that's really quietly happening. We're seeing developed foreign broadly. We're seeing segments such as Latin America, Mexico. I mean, there's a lot of spaces outside the U.S. that truly could be in earlier stages of a more secular advance, and that would be commensurate with a continued weaker U.S. dollar, which we've already seen a lot of progress on that front. Yeah.
So I've been saying for probably at this point well over a year that set it and forget it is really challenging.
It is.
Now I will say that if you just sat in the S&P 500 for quite some time, you're doing just fine, right? But there is opportunity to create alpha, or what we call, excess return is what we call alpha in these markets because of the volatility.
Absolutely.
I think we mentioned that earlier with the bond market. For years the bond market was just meh. It really wasn't much to do because the interest rates are so low. Now there's opportunity to find return. I think you're also finding that. You had mentioned this earlier in the year, small caps. And anything other than tech, the opportunity to create that excess return.
Yeah, with the focus around quality and cash flow, dividend payers. If we look at the last couple decades, dividends have been a small component of total return. It's been appreciation in large part, really going back to QE era in 2009 and before. And we think that quality and cash flow matter significantly, regardless of where you are on the market capitalization structure, small, mid cap, and large cap. That focus going forward is important. Because if we look at in 2023 and looking back, we'll end up having a 3% plus GDP year, a 25% plus growth in the S&P. Yet, from an earnings growth perspective, we have not seen that. Right. Earnings for 2022 were about 218. We'll come in at, maybe 220, 221 for 2023, which is really no growth, more or less. And so I would contend that as we look over the months and quarters to come, that the market does an excellent job of discounting future expectations. But this is where the rubber meets the road. We really need to see an upward trajectory in earnings. And candidly, we're not seeing that yet. When I look at the Dow 30 companies from just 2 months ago, there's only been 13 of the 30 that have increased earnings estimates for 2024. The others are slightly lower.
So is the market celebrating that we didn't lose that bad?
Yeah,
I mean,
it's a good question.
You and I both are, ex-college athletes.
Yeah.
The University of Missouri goes into Georgia this year and didn't
Right.
lose that bad. And it was sort of the same
victories.
thing. Yeah, moral victory. Is it a similar type situation?
I think it's focusing on Fed first.
Yeah.
Policy has had so much influence, especially in these last couple of years. It's declaring victory of the Fed being out of the way, but again, that's a tricky game. The market's forecasting 6 cuts next year. The Fed is mapping 3 cuts.
Right.
So, I would contend if we have 6 cuts in an election year, then it's probably not for great reason.
Right. There's an economic issue.
I think so.
Yeah. The big R, the big recession coming.
I think so. And we've seen a glimpse of this could be anecdotal, but when we look at big bellwether type companies, FedEx and Nike, they're talking about margin compression or revenue slowing at some level, and that's a real risk. And so while slowing growth and declining inflation, which the Fed is successfully navigating so far, is good from a policy perspective, but it's not great for earnings. We really need to see margin expansion from these levels, and that's what the market's banking on seeing, and increase revenues. And those are some counter forces there. So.
I guess we'll see next year if we win the game, win the difficult game, i.e. the Missouri Tigers playing Ohio State.
Right. Yeah. There we go.
Tomorrow, actually.
That's right. So. It is tomorrow.
Okay, John. So next year, you're I think you and I are very similar in how we approach portfolio management.
Yep.
And it's sometimes we're headline contrarians.
Right. Yeah.
Where people are optimistic, you and I get a little bit more nervous. We still stick to the fundamentals, but ultimately it's about being prudent with the assets we're managing.
Yeah, that's exactly right. Going counter to trend and consensus. It's the old Warren Buffett. Be fearful when everyone's greedy, and vice versa. And we're definitely in a very optimistic. Greedy might be a stretch, but we're definitely closer to that in this environment than fearful. So prudence just around risk-taking. The messaging of staying in the game is a really great one from these last 2 months, especially given the magnitude of the run and segments of the market that most weren't anticipating. But being mindful around risk exposures and finding sources of return different than just pure market beta as well.
Well, great. Well, thank you, John, for the time. I appreciate it. And thank you all for allowing us to be stewards of your wealth, to manage your portfolios and take care of your family's hard-earned money. For John MacArthur, I'm Kent Scorney. Happy New Year to you all. Thanks a lot and have a great day.